This program is brought to you by Capital Financial and Insurance. Coming up on the Financial Safari, Coach Pete and economics professor Frank Roach, followed by Coach Pete talking with your local trusted advisor Peter Rashan about the rule of 4%. And later, Coach Pete is joined by Tom Lydon to help explain what ETFs are.
Hi, this is Coach Pete, and if you've got questions about how to safely and properly allocate your investments, you're in the right place. Welcome to the Financial Safari.
Broadcasting from coast to coast, it's the Financial Safari with your host, Coach Pete D'Arruda. Coach Pete and his guests are some of the nation's top financial professionals. They make it their mission to guide investors through the treacherous jungle of the financial world, showing them how to grow, keep, and leave their money for their loved ones. So stick around and find out how to make it through the jungle of the financial world on the Financial Safari.
So, Coach, let's talk a little bit about what it takes to put together a secure retirement plan. What are the elements of a secure retirement plan?
You know, well, the first thing you have to admit is that someday you're going to retire. And a lot of people don't admit that, or don't think about it. I mean, every day is another work day, and then the weekends come, and planning that 1 or 2 week vacation coming up each year. And matter of fact, studies have shown most people spend more time planning their 1 or 2 week vacation than they do about their 30 or 40-year retirement. And that's just the society we're in nowadays, the immediate,
Sure.
I call it gratisfaction, getting satisfaction right away instead of putting things away and thinking about later. But the first step is to admit that you're going to retire, and that's a big step sometimes, Well,
I think that's an interesting point that you bring up because people often look forward to going on those vacations, but a lot of times people don't look forward to retirement, and that's really too bad. But people get bogged down by everything that has to go into retiring and everything that you have to consider and plan for, but it shouldn't be that way.
Yeah, and now let's say that you do admit you're going to retire someday. The next step is to decide, number one, you need to figure out where your money is right now, and hopefully you've saved some money in the course of maybe 401ks or inheriting money or whatever you've done in your lifetime of working years. Hopefully you've saved some money, and if you're within 5 years of retirement, we call that the financial red zone. If you think about a football game, Walt, the red zone is defined as the 20-yard line into the end zone.
Right.
And
when you're close to scoring.
That's right, close to scoring. And when a team gets down there, what they do is they get a little more conservative in nature. They're not trying to throw the bomb and not trying to take risks when they get the ball close to scoring because, and I've seen this watching a football game, when a team does take too much risks, all of a sudden the ball is going the other way, we call it, and that's called a pick six in the NFL or the college days. And that's when you're almost getting ready to score and you make a mistake, and not only do you lose the ball, but the other team gets the ball and goes the other way and scores. And so it is a game when we're talking about the financial world. So you want to advance and protect your money as you get inside that financial red zone. And watching football when I was little, I was a New England Patriot fan, and there was a big fullback. His name was Sam Cunningham, and they called him Sam Bam Cunningham because they gave him the ball, Walt, and he always went frontwards. It doesn't matter. It didn't matter. The whole team, the whole other team would know he was coming. They would still go forward with him. He would always wrap the ball up with two hands and go forward. And you want to do that in the time of your life when you're getting close to retirement. Again, the financial red zone. So getting safe, secure strategies in place, some that have a guarantee of lifetime of income in the future that you can't outlive, and then also have a little bit in reserve that you can take some risk with. Have that surprise factor, we call it. And getting a planner that understands this is vital. So you need to interview different planners, ones that concentrate in dealing with people 50 and older are optimum these days when you get close to that financial red zone.
So advanced and protect. Explain that in the financial world. It makes sense with the running back, but what about the financial world?
Well, you want some financial strategies that will make sure that regardless of the environment we're in financially, and we're going to go up and down. We always go up and down. You know, we've had a good run up, but it could change and it'd be a bad run down. But you want to make sure that some of your financial strategies, no matter what the environment is financially, are always either staying the same dollar-wise or going up. And especially when we need that money for retirement, we need that money to grow. And there are some vehicles out there, safe money vehicles for income planning techniques that will grow your money anywhere between 5 and 7% per year for the sole purpose of in the future someday, you'll say, hey, my money's grown by 5 to 7% per year. I'm ready to flip that switch and now get a lifetime income from these accounts. They're not lump sum accounts, they're income. Vitally important these days, Walt.
So you make a little bit protected, make
That's
more
right.
protected, and that's the key to retirement.
Advance and protect. Retirement Autopilot. Income planning starts with the end in mind. What do I mean by that? It means you look at where you want to go, and then you design a plan that will give you the income you need to get there. Doesn't matter what time of your life you're in right now. You could be just starting to work, you could be midway through your career, or you could be ending your career. You're always going to need income. When you're working, you get a paycheck. That's your income. Hopefully you're taking some of that money and putting it aside for future when you don't get a paycheck. I call those play checks. Now the play check is your income plan. It's the money that's going to come each and every year, making sure you never have to worry about running out of money in retirement. There needs to be some guarantees attached to that paycheck. It starts by building the proper foundation. Just as a home builder lays down concrete and rocks and gravel to make sure you have a solid foundation, it's always good to have a good foundation in place with your financial future. Financial foundation is your safe money, the money that will always be there for you to and through retirement. So there are some products, there are some strategies designed exclusively to make sure that you never have to worry about going backwards. We call this financial cruise control, otherwise known as income planning. If you set it up correctly and do financial cruise control, you can always get that paycheck, the money that will always be there regardless of what happens in the market, making sure that you can take the worry out of living in retirement. That's what we call income planning. A proper income strategy does not depend on what happens in the market. It all depends on you and getting a proper planner so that you don't have to worry about where the money's going to come from. So we're here in the studio with Mr. Frank Roche. Now, Frank is an economics professor at Elon University. He's also a trader of currencies. I like to have him in every now and then to get the perspective of what's going on in the local economy as well as nationally and worldwide. Frank, welcome in.
Great to be with you again, Pete. Always a pleasure.
Well, let's talk. I mean, you know, there's never a lack of things to talk about. There's so many things to talk about. You and I were trying to talk before the show what to talk about.
Right.
So I'm going to let you. What's important today? What's important in Frank's world?
Well, what's important in my world always is America and how it relates in the world and how I can make a greater living and how those of us and our fellow citizens can have a greater life.
Yep.
And the focus right now for me is on Cyprus and Europe, what's going on in North Korea, what's going on in Israel and the Middle East. But we can bring it right back home to the economy here in North Carolina, which is not doing that well. We just had some economic data this week that implies that North Carolina continues to lag the nation in terms of economic activity. So we think about these big picture things. You can bring it right back to Main Street very quickly and focus on how are we going to get the economy improving a little bit better.
Okay, well, here's an idea for you. What about no income tax in North Carolina? That idea has been floated around. That would definitely help. It's really helping in Texas right now.
Yeah.
I've got a friend down there. The values of real estate is skyrocketing because folks from states that have income tax are moving to Texas and droves of people.
Well, that's one of the potential reasons for it.
Yep.
Of course, Texas has a very healthy economy, has been for some time.
Right.
They have, in terms of job creation, one of the best states in the country.
Yep.
So the tax issue is important, but let's not get fooled by this. People forget we eliminate the state tax. Wow, it's a benefit for everybody. Well, really, we're just essentially creating a value-added tax at the retail level, because all state income taxes are replaced by a sales tax.
Yep.
So remember now, even Republicans and Democrats, they all talk about revenue neutral tax policy,
Yep.
which implies if we get rid of the state tax, we're going to get tax revenue elsewhere. So don't be fooled by, it's a zero-sum game right now when it comes to no state taxes.
Okay, well, here's my
nice
thing.
idea, though, but not as perfect as everyone thinks.
But sales tax are already here, right?
Right.
So they'll go up, but we're still getting zonked there anyway. So what's to stop them from raising the sales tax and keeping the income tax?
Well, that's we don't want, of course.
Yeah, that's
now
not
there's
good.
a good argument to be made for this case. Don't get me wrong. I just want to make clear we're not getting a complete benefit from eliminating income taxes.
So you're doing a consumption tax more than anything, right?
Which is okay because that now incorporates many more people into the tax structure, especially illegal immigrants. Very wealthy people get taxed at higher rates because of the items they purchase. So there's a value-added tax, consumption tax component that's very important there.
It would be a boom the day before they went into action too. If we knew the sales taxes were going up, people would go out and buy a whole bunch of stuff.
Well, that
Of
could
course, there'd
be
a bust after that,
yeah.
though.
You know that kind of stuff. You make it now, you give it back later.
Yeah.
So like the gun issue over the past few months.
Boy, you'll look at the gun
Record
sales.
gun sales, right? But you know what's going to happen in 3 years? Gun sales are going to drop.
Yeah,
Because everyone's consumed their gun.
There'll be sales on the secondary market, and there'll be pawn shops getting a lot of guns.
Right, but the point is you front load these things,
Yep.
and the same thing applies with tax efforts.
Okay, so with the North Carolina economy, though, is in little bubbles, it's fine. Like the Raleigh-Durham area, we're seeing it pretty good.
Where we are today, we live in a pocket of prosperity.
Charlotte area is good there, too. But when you go out of town just a little ways, there are a lot of areas that are suffering.
Yeah. North Carolina's been hammered hard by international trade policy managed in Washington, D.C., and it's across the state. Furniture is one of the best examples, but it's not just that. It's everything that anyone else can make outside this country.
Well, textiles and tobacco. I grew up in Scotland County, Laurinburg. I mean, I think it's the worst county in the state now for income because there's no factories
That's
anymore.
1970s, 1980s, 1990s. Of course, we have some components still there, but now the 2000s, furniture's gone, manufacturing's gone. So it's a real challenge, especially in rural counties across the state.
Well, we've got a lot more to talk about, and we're going to have you on again in the future. I want to talk about some of the different countries out there, some of the things that's going on, bank grabs or grabs of bank money,
Sure,
and
Cyprus,
things like that.
yeah.
And folks, we'll be right back after this.
Still to come on the Financial Safari, your local trusted advisor, Peter Rashan, explains the rule of 4%. And later, Coach Pete hits the streets in Pete on the Street. And now, Coach Pete has a special offer just for you.
So, as we all know, this is a confusing world we live in, and the financial world is confusing as well. But if you call in the next 30 minutes and mention that you heard this offer on the TV show, we'll put together for you a customized lifetime income report. We'll also do a forensic fee analysis, helping you look at where you are right now and making sure you're on the right path to get you to that retirement of less worry and more income. Folks, we'll also do a tax analysis using a CPA that we work with at our company to make sure that you're not overpaying on taxes. Again, the more money you keep in your pocket, the more money you'll have in retirement. All these things and more, as well as a copy of my new book, 7 Financial Baby Steps, are all yours when you give that number a call and come in for your no-cost financial consultation. Look forward to seeing you soon. What is a laddered income strategy? Laddered income strategy we call financial cruise control. It's about those dollars per year, DPY, making sure you get enough money coming in for the rest of your life. Now, how do you do this? The first thing you must do is identify where all your assets are right now and making sure to find some that you want in these financial cruise control type accounts. Now, financial cruise control is just looking at what you have right now and what you're going to need in the future. Because as you get older, some of the money you have must be in a place to give you that income that you don't have to worry about as you get older. If you want to picture a speedometer goes up and down as you press the gas and let the gas off. If you could get a speedometer or a car that would go in one speed at all times, that's income planning, making sure you have that financial cruise control that'll keep you going to and through retirement. Now, a tachometer is that other gauge that's in a lot of cars that shows you the revolutions per minute that your car's engine is going. And if you have too much risk, you'll notice the financial tachometer bending over to the red part of the gauge, and that's not good. So if you get close to the financial red zone, which we look at, anyone 55 and older is in the financial red zone. You're getting close to retirement, or you may even be retired. So it's vitally important that you have that money tachometer attached to your accounts. Financial cruise control is just looking at the assets you have now, taking some and putting them in a place that you will have income regardless of what happens in the market. That's why we tie that in with a laddered strategy, because if all your money is tied to the market, when the market goes the wrong way, your future income suffers. So the opinion here is, take some money off the table each and every year from the risk world, put it into a laddered income strategy so that as you get into retirement and further through retirement, that your money is always going up, it's always coming in, and you never have to worry about what's going to happen if the market goes the other way. Laddering your money, getting a proper laddering strategy, will give you that peace of mind knowing that you have money to and through retirement, and you never depend on the market's ups and downs to get you what you need to get in the future. And now it's time to check in with your local trusted advisor.
I'm Peter Rashan, Retirement Planning Specialist and Vice President of Capital Financial Advisory Group.
So today's question evolves around the 1, 2, 3s of money. Can you explain what they are and why they're important to everyone watching?
Well, Coach Pete, I believe that you are referring to the different qualities that money can have. In other words, what it can do for you, the job that it's supposed to perform. And different investments have different qualities or different jobs that they can perform for you. The three big goals of money are growth, safety, and liquidity. These three things you want as much of in your total portfolio. However, in any one investment or savings vehicle, you can only have two of these three qualities. So in other words, in a bank, it's important to have safety and liquidity. You know the dollars are there and that you can get your hands on them when and if you need them. However, you're not getting much growth in the bank account. In a market-based account, like stocks, bonds, or mutual funds, the goal is growth and liquidity. If you have a dog fund or a loser stock, you can sell it and trade it in for another fund that may be a better fund. But you don't have any guarantees for safety. And then finally, there are some asset classes such as treasuries, bonds, annuities, real estate, even longer-term CDs versus shorter-term CDs, where you can give up a portion of your liquidity in order to have more assurance for safety and growth. So again, proper asset allocation is going to be important for achieving all three of these goals. And then, also important to know, in retirement, there comes a fourth quality of money, which is income. Can your money produce a predictable stream of income? That's going to be the most important factor in determining whether or not you have a successful retirement, that you don't have to worry about where your paycheck is coming from.
Fantastic. And as always, thanks for coming on today and sharing your vision with our viewers.
Well, Coach Pete, I always appreciate the opportunity to be on the Financial Safari and talk to our viewers. And of course, there's a great offer coming up for them to call if they would like more information.
Talk to one of our local experts, and we have a special offer for you on today's show. Call in the next 30 minutes, and we're going to custom design for you an easy-to-understand financial review that will indicate if you're in need of a full-blown financial plan. There's no obligation or cost for this initial review for all callers who have at least $200,000 saved for retirement. If you meet those qualifications, here's what you can expect. First, we'll run a fee report to help you untangle what it's costing you to work with your current planner or advisor. We'll show you how to protect your investments and keep more of your money in your accounts. Next, we'll perform a tax analysis to show you how you could possibly be reducing your taxes and increase your cash flow. And finally, we'll create a customized lifetime income plan using proven strategies and techniques that could turbocharge your retirement income. In short, we'll take the guesswork out of financial planning for you. So, for all callers who call in the next 30 minutes, a comprehensive financial review that we're offering with no obligation. Just call the number below right now.
It is now time for Pete on the Street.
Pete.
person has to say.
This is Pete on the street, and today we're with Bud. And Bud, we're going to ask you a couple questions here. Number one is, what's the most pressing thing you've gone through here in retirement?
Well, the stock market fallen, I've lost 50% of my retirement.
And how have you felt about your current advisor? Has he or she been in touch with you on a regular basis to make sure that you were informed about what was going on in the stock market?
Now, I went down to my advisor several times, and all he said was, keep your money in the stock market. It's going to go up, and I hate to see you lose the money. When it goes up, you won't be making any money. Stay the course.
How'd that make you feel?
At the time, the stock market was starting to fall, and so I just took his word for it. I don't know anything about stocks and bonds.
And how big of a hit did you take by taking that non-advice, basically?
At least $40,000, 50%.
On the street.
Coming up on the Financial Safari, Coach Pete is joined by Tom Lydon. They explain how ETFs can be a part of your portfolio. And a special message from Coach Pete.
And welcome back into the Financial Safari. This week we have a very special guest. He's joining us from Orange County, California. His name is Tom Lydon, and he's written a book that got on my radar screen. I wanted to have him on because of it, but he also does a lot of other fascinating things. The book title is The ETF Trend Following Playbook, Profiting from Trends in Bull or Bear Markets with Exchange-Traded Funds. Tom, welcome to the show.
Thanks, Pete. It's great to be with you.
Now let's talk ETFs. I mean, this is a phrase that draws cold sweats in people when they hear that a lot of times, because and even people in the know, that are supposedly in the know, Tom, people don't understand what an ETF is. So for our audience, can you take us from square one, tell us what an ETF is, and then square two, tell us why they are a good part of a portfolio many times?
Absolutely, Pete. And for a somewhat confusing name and even complicated acronym, it really is a simple product. The whole idea about an exchange-traded fund, it is a mutual fund. It's a form of a mutual fund, but 99.9% of them are index-based. So the advantage here is you're following an underlying index. You know what the constituents of that underlying index is. You don't need to pay a manager, so the expense ratios are just a fraction of what you're paying in a actively managed mutual fund. It's very tax efficient, and more importantly, it's liquid. So you could actually buy one in the morning and sell it in the afternoon, as opposed to a mutual fund where your buying and selling is executed at that night's closing price. So we've seen a huge adoption in the ETF area. There's $1.4 trillion in ETFs, and over 1,400 ETFs available today. We've come a long way from just the S&P 500 ETF SPY that was the first one that started 20 years ago.
Yeah, and I still see a lot of confusion out there when people are trying to make their investment decisions. Either they try to do it themselves, where they try to pick individual stocks, or get some of the magazines and start reading about mutual funds to invest in, or ETFs. That's not the right strategy a lot of times, is it?
Well, you're right. I mean, if you looked at the average investor portfolio, most of it is chock full with actively managed mutual funds, and 7 out of 10 actively managed mutual funds over time have underperformed their benchmark, and they've got big expense ratios. So if all you did is replicated that asset allocation with ETFs within the same asset classes, two things would happen. Number one, you'd align with the benchmark because they really are indexes that meet those benchmarks. And number two, you probably save yourself over 1% in annual expenses because the expense ratios are so low. So it would just overnight clean up your portfolio, make it so much more transparent and liquid, and you'd be aligned with what your overall goals are.
Folks, we're talking to Tom Lydon. He's the author of the ETF Trend Following Playbook, Profiting from Trends in Bull or Bear Markets with Exchange-Traded Funds. If you had to put a percentage on the number or the amount of hidden fees in the 401k, I talk to people all the time and they say, hey, my 401k is not like one of those you talk about on the radio. I only have a $25 fee per quarter. It shows it right on my statement. Tom, that's the tip of the iceberg, isn't it?
Well, absolutely. When you peel back the onion a couple of layers and you see all the expenses in running the 401ks, the 12B1 fees that the person that's selling the 401k to your company gets, it just adds up. And ultimately, there's not enough disclosure. And, you and I could go on for hours about this. But hopefully, we're seeing Congress is on this. They're mandating better disclosure, better performance disclosure as well. And, ultimately, the government really does want what's best for the average investor and the average employee. And I think we're gradually getting there, but not quickly enough.
I was talking to somebody in the office the other day, and I said, how long have I been talking about those hidden fees in 401ks? And he said, for as long as I've been employed here, and he's been here 7 years. Tom, it's not coming fast enough. Hopefully the government will do something, and hopefully people will get educated on the ETF world, because there are a lot of hidden gems there. Again, educate yourself, folks. Tom, what's your blog one more time?
It's etftrends.com, and feel free to send me an email if you have any questions.
And we'll put a link to your site from our site, financialsafari.tv. And Tom, as always, it's been great having you on the Financial Safari, and I hope to have you on again in the future.
Pete, thanks. I really enjoyed it.
The pleasure's been all on this side of the microphone, Tom. And folks, we'll be right back after this. Wow, we're here at the end of the show again. I thought we just started. That's how fast life goes. And folks, you can call a financial timeout, get your accounts on retirement autopilot, making sure you're doing the right things for your portfolio. Call the number you see on your screen, and we look forward to seeing you next week on the Financial Safari.
Information provided is for illustrative purposes only and does not constitute investment, tax, or legal advice. Information has been obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed. Neither Peter J. D'Arruda or his guests are liable for the usage of information discussed. Always consult with a qualified investment, legal, or tax professional before taking any action. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Individuals should thoroughly review the contract for specific details of the product features and costs. Income payments and withdrawals from deferred annuities are generally taxable as ordinary income in the year they are taken.
Hi folks, so glad you were able to join us here on the Financial Safari. If you feel you missed anything or want to see things again, you can visit us anytime at financialsafari.tv. When you go there, you can also download a chapter of my newest book, The 7 Baby Steps, as well as qualify for a retirement power pack to make sure you get informed properly. Again, financialsafari.tv.